们就在这边介绍一下 Ken is a vice president for First American Exchange Company. And so welcome to Ken to helping us to understand the 1031 exchange knowledge. Welcome.
Thank you. Thank you so much. Thank you for having me. And if we could get the next slide for 1031 exchange. So what a 1031 exchange is you're selling a piece of real estate. When you sell a piece of real estate you held for investment, you created typically a gain, especially in these times with higher values. There's a capital gains tax, and when you have a capital gains tax on the property, you're either going to have to pay a tax on the gain, or with 1031 exchange, it's a legal way to defer that capital gains tax. So what you have to do is buy other real estate to basically, what I like to say is kick the can down the road. You're going to defer that capital gain into the next piece of real estate. So instead of paying tax on your sale, you're able to buy other real estate with that money and hopefully make yourself more money, or do whatever the game plan is for yourself or your client, and diversify or consolidate. You know, everyone has a different game plan. So there's many people that can benefit from 1031 exchange. So what's happening in a 1031 exchange is you're going to sell property that you held for investment and buy like-kind property. I'll expand on like-kind here on another slide. It has to be for investment or a business use. So the real estate has to be an income-producing piece of property, but it could be a single-family residence rental. It could be a commercial property you're using. It could be a property you run your business out of. So, you know, the mechanic owns the real estate. He can sell and do an exchange on the real estate. It could even be a mixed use type of transaction where you sell your primary residence, but maybe you ran your business out of that. Maybe you rented out rooms. Maybe it's a duplex that you live in half and you rent out the other half. So there's possibilities you can do a 1031 exchange on something that is a mixed use and maybe used for personal use too. And then what you got to do is obviously follow the 1031 exchange rules, which I'll go into now. If you want to change the slide. So capital gains, when you do a 1031 exchange, this is kind of a brief, shallow description of gains. So you buy a property originally for $300,000, and now you're selling it for $1 million. Not very uncommon to see. So there's a $700,000 gain. So when you have a $700,000 gain, that's what you'd pay your taxes on. So with a $700,000 gain, your federal capital gain rate could be 15 to 20%. And the 15-20%, it depends on your income. So everyone's different. But in a situation like this, it's an aggregate income. So I would automatically know that they'd be in the higher tax bracket for the federal at the 20%, because the gain is part of your income. So it's an aggregate income. So in this situation, if the client has a $700,000 gain, and even if they didn't earn a dime in income for work that year, they're in the higher tax bracket because they show that they earned $700,000 on the gain. You have a 12.3% capital gain rate on the state of California. Every state varies, so depending on where the property is, you know, it could vary. California is naturally one of the higher ones. Then you have a Medicare tax that's applied towards capital gains too. This came through with like Obamacare back in the day. When that came about, they apply a 3.8 Medicare tax if your income is $200,000 for a single person or $250,000 for a married couple. Again, it's that aggregate income that's applied towards capital gains tax. Also, there's a depreciation recapture tax of 25% of any depreciation taken on your investment property. So on a situation like this, it all varies, but you know, usually we're going to look at this as being a $225,000 or $250,000 tax hit because of the sale. So the whole idea of the exchange is, let's not give Uncle Sam, the government, the $250,000. Let's keep it for ourselves as the client, put it into other real estate to hopefully make that client more money, or you more money, by doing a 1031 exchange. Okay, next slide. So what are the requirements of the exchange? So what I do is act as a qualified intermediary. The 1031 is a tax code, and you have to have a good 1031 exchange. So prior to closing the sale, we need to get involved. So I always say, once you open the contract, you open escrow, get me involved. Now, I like to talk to my clients prior to even entering contract. You know, we want them to have a game plan. We want them to make sure that it makes sense for them to do the exchange. But you definitely want to get us involved so we could coordinate the 1031 exchange with the escrow once you have the contract prior to the closing. You have to do the like-kind properties for business. There's timeframes. You have 45 days to identify and 180 days to close. These timeframes start the day you close escrow on the property you sell. And this is important too, equal or greater value. I'm going to get into a couple examples of that. When you do an exchange, you want to buy property of equal or greater value and equal or greater equity. So going back to that previous slide where you had the $1 million sales price, in order to defer all those taxes, you'd have to buy something for $1 million. So that $700,000 gain, let me explain that. So you have $1 million sales price, you have that $300,000 basis and a $700,000 great gain to make up your $1 million sales price. So if you sell it, you're subject to taxes on the $700,000 gain. Now, if you do an exchange, what happens? It kind of changes it a little bit. You have to buy of equal or greater value because the basis value, the $300,000, transfers to the asset first. And then the other $700,000 has to go to the next property next. So basis goes in a chunk first, and then gain has to transfer over to the property. So that's why you need to buy of equal or greater value. So if you sell for $1 million and then buy for $900,000, well, you only have enough value to put $600,000 of gain over there. You'd be subject to taxes on the $100,000. I'll have some examples on that in a couple slides too. We could go to the next slide. So, and then the other thing too, I want to point out, I was actually on a call this morning. The client was selling under his own LLC, and then he wanted to buy something in another LLC. He's basically going into a partnership that'll buy the property. But if you're doing an exchange, the taxpayer that sells must be the same taxpayer that buys. So if I'm Ken Harris selling under Social Security number 123, I need to be Ken Harris buying under Social Security number 123, a piece of real estate. Now, it's possible for me to buy a tenant in common interest in the property, say a 50% interest, and I can buy with another party that's not exchanging, but we can't create a partnership, say an LLC, to buy the property because I have to meet my same taxpayer requirement for the 1031 exchange. Okay, go on to the next slide. So getting us involved prior to the close of escrow means we're gonna coordinate the exchange. We prepare the necessary exchange agreement that's required under the tax code, and we get assigned into the transaction. So the First American Exchange becomes the qualified intermediary. Essentially, we don't go on the deed, but the assignment assigns us into the transaction so that the proceeds of the sale can come into us as the qualified intermediary. Taxpayer cannot control the funds. So the funds come into us. We hold on to those funds to apply towards the purchase of the replacement property within the timeframes of the exchange. One of the positives that we do, we hold the funds in a separate account for every client so that it's for their security, so they get the FDIC insurance on that. And then you have the fidelity bond for First American. You have the heirs and emissions insurance. Both of those are multi-million-dollar insurance policies. And also you're backed by First American, which is a multi-billion-dollar publicly traded company that's been around since 1889. So one of the most important things when you're picking an accommodator, a qualified intermediary such as us, is financial security, which I think we offer on our end. Next slide, please. So what is like kind? I brought this up before. So a lot of people think there's a misconception out there. Oh, I'm selling a residential property I've been renting. The like kind means I have to buy a residential property that I'm buying to meet the like kind requirement. But that's not necessarily true. It's fairly broad for 1031 exchange. Any real estate held for investment can be exchanged for any other type of real estate to be held for investment. So as you see here, everything is like kind. Real estate and residential rental can be exchanged for industrial for commercial for units, retail. The one thing you'll see there is vacant land. That's the one circumstance you may do an exchange on that may be not income producing. So it's possible to do an exchange out of vacant land even though you may not have an income on it. So I do recommend, if you or your clients have vacant land, sometimes selling the vacant land that's not income producing you can exchange out of it, not pay your tax by deferring it through the 1031 exchange, and get yourself a single family residence that's going to net you $3,000 a month in rent. So selling vacant land may make sense. Now, going from an improved property to a vacant land, one of the things you're deferring, as I mentioned on a previous slide, is you have a depreciation that you take on your investment property. What you depreciate is the value of the improvements in the exchange. So if you go from an improved property to a vacant land, you're going from a depreciable property to a non-depreciable property. So you can actually do an exchange to defer your capital gains tax, but you still will get hit with a depreciation recapture tax on the depreciation you've taken on the property you sold. So going into vacant land, you can do it, but maybe it doesn't make sense because it still creates a tax consequence. Maybe you're not going to make money off of it, but maybe there's plans to develop and make money off of it later. So sometimes it makes sense for the client. Okay, so all of that's interchangeable. Timeframes of the exchange. So when you do an exchange from the date of close of escrow, you have 45 days to identify. I'm going to go more in depth on that on the next slides, but let me explain the rules. You can't just identify the entire United States and then choose from those. The IRS limits what you can identify when you do a 1031 exchange. So most commonly, we see what's called the 3 property rule, where you could identify 1, 2, or 3 properties at any value. Now, of course, you want to meet your equal or greater value, but let's say you sell one for $1 million, you could identify 3 $1 million properties and then choose from those 3. So you could have a couple backups in that scenario. Or, sometimes you could diversify and you could identify a $500,000 and two $250,000 properties, and you could close on all 3 to meet your equal or greater value of the $1 million. So there's a couple different ways you could use that, but usually always in every exchange, you could definitely always identify up to 3 properties. Now, if you want to identify 4 or more, you are limited to the 200% rule. So what that says is you could identify 4 or more, but you have to apply a fair market value to everything you identify. The total combined fair market value cannot exceed 2 times the value of the property you sold. So going back to my previous slide where I said you're selling for $1 million, you can sell for $1 million, and then you could identify up to $2 million worth of properties. So under the 200% rule, you could identify 4 $500,000 properties, 10 $200,000 properties. And then let's say you did that. You did 10 $200,000 properties. All you need to close on is 5 of them to meet your equal or greater of $1 million. Okay, so you could have backups under that scenario too. I'm going to go into the 95% rule real quick. I've been doing exchanges for over 20 years. I've seen this done maybe twice, and it was a portfolio closing. So I'm going to give you an example of this. 95% rule says you must acquire 95% of the aggregate value of what you identified. So I use the example. You sell for $1 million. You want to identify 10. So the 3 property rules out. And each of the 10 are $1 million each. So you're above the 200% of $2 million. So you don't qualify for the first 2 rules. What it says is you must acquire 95% of the aggregate value of what you identified. Otherwise, it destroys your entire exchange. So if you identify 10 properties, you closed on 9 of the 10, you only closed on $9 million of the total 10 million. That means 90% of the aggregate value. So you didn't meet the 95% rule. It destroys your entire exchange. So the only time you see that used really is a portfolio closing. You're closing on 20 properties, all over the state of California. And it's one closing, one seller, one buyer. And it's all or nothing anyway. So that's really the only time you'll see the 95% rule. So for the most part, you guys will focus on 3 property rule and 200% rule. And then as long as you close on what you identified within 45 days, within 180 days of closing the sale, you could have a good 1031 exchange. If you bought of equal or greater value, if you bought of lesser value under the 3 property or 200% rule, you just get taxed on the difference. Okay, we can jump to the next slide so I can focus on the time frame. So day 0, let's say we close today. Today's day 0 of your time frames. So close of escrow of your relinquished property is day 0. And then if you tab, day 1 would be the next day, date after closing. And then the 45 days, you have 45 days from today to identify under those rules that I explained. And then you have 180 days to close on what you identified within 45 days. I want to make a note. You cannot change your identification after day 45. So remember also, closing triggers your time deadlines. So if you close today, your time deadlines are ticking and there's no changing it. You know, a lot of times people will put in their contract, offer an option to extend the close of escrow so their deadlines don't start. Okay, so close of escrow starts it. You can't change it. You can't change your identification after day 45. So you really want to know what you're doing. I always say your best exchange is close today on the sale, close tomorrow on the purchase. I know that's hard because of the timing. You know, do you have the money? Can you verify the funds until the relinquished property closes? But at least if you could be in contract by day 45, you don't have to be. But if you're in contract, at least you have something locked down knowing you could buy it. If you identify blindly on day 45, go put offers on day 50, you can't buy what you identified, then you're going to have a failed exchange. Okay. And at that point, you may not get your money back until after day 180 because there's a restriction of the funds. We can only apply it towards the acquisition of the identified properties. So you've got to play the game. You got to be really ready to close on your purchase or be in contract at least by day 45, hopefully, even though it's not mandatory. Couple notes there. Earlier of 180 days, we're approaching the end of the year. So you must report your 1031 exchange in the year in which you sell. So if you close, say, December 1st, your 180th day falls on June 1st, let's say, that's past your tax filing deadline date of April 15th, which means you must close on your replacement property before your tax filing deadline date. But it's usually not a big deal because you can file for a tax extension to get the full benefit of your 180 days. Okay. Another thing too is if it falls on a holiday or a weekend, we can't push your deadline date to the following business day. It limits your 45 days. Well, 45 days, you could always identify on a weekend or a holiday by emailing us in the identification form. But at least as far as closing goes, you must close the previous business day to the weekend or the holiday. There's no pushing it to the following business day. Okay, next. So equal or greater value, equal or greater equity. I kind of already touched on this anyways. Again, selling for $1 million, you buy for $1 million. The equity also must go into the purchase. That's why it comes into us. All that same equity must roll into the purchase. So there are circumstances where a client might want to exclude some of the equity, you know, so you can exclude it, pay a boot, like I'll boot, it's going to be a taxable event, and then just do the rest of the net proceeds. But the idea to defer all taxes, use all that equity to buy something of equal or greater value as to what you sold. Fresh debt or cash can offset debt. So there's a misconception out there that you have to replace debt for debt, which is not necessarily true because cash will offset debt. So let's say you paid off a $400,000 loan on that $1 million sale. People think you have to get a $400,000 loan again. But if you wanted to bring in $400,000, if you're buying for $1 million again, you could bring in the $400,000 out of pocket or do $200,000 out of pocket and a $200,000 loan to make up the difference. So cash does offset debt. Okay, next one. So here's just a couple examples. So this one is, you know, sold the relinquished property for $300, bought the replacement property for $300,000. So the equal or greater value is there. But if you look at the loan amount, they paid off a $100,000 loan and then got a loan for $150,000 on the acquisition, which only allowed us to use $150,000 of the equity, which would leave us with $50,000 left over in the exchange. So you don't want to get too high of a loan amount to where you don't use all of the funds in the exchange, because this would create a tax consequence on the $50,000. So typically your lenders are going to request from us a verification of funds so that they know to adjust their loan to use all the equity from the sale. Next. And this is a perfect exchange. So you sold for 300, bought for 400. So the equal or greater value is there. You paid off a loan of 100. And then the new property, you got a loan of 200, which is higher, but that's okay because the purchase price is higher. So that still allows us to use the full $200,000 equity to defer all their taxes. So they bought of equal or greater value and of equal or greater equity. So they were able to defer all their taxes. Again, that loan, if they didn't want that loan, they could bring in cash if they have the cash of $200,000. So equal or greater value, equal or greater equity. I think that wraps up the slides. The next one, I think, is just questions. Yeah, so that's my information. I know I gave you guys a lot of information. Please take down my information. Feel free to call me anytime. There's so much more. I've done these classes for 3 hours and I was driving home and thought, oh my gosh, I forgot to tell them about this. So there's so much to it. There's reverse exchanges where we close first on the purchase, maybe improvement exchanges where we can improve the replacement property to add value to it to meet their equal or greater value. There's so much to it. Please feel free to call me anytime. I'd like to help you guys out and your clients out and deferring the taxes and helping you make more money. Thank you guys for your time.
Thank you, Ken. Thank you so much.
Thank you.
Bye.
Thank you. Bye. Have a great day.